enabled.
Kotak Mutual Fund presents Investmentor in association with Network 18.
Hello and welcome to this special show. Kotak Mutual Fund presents Investmentor in association with Network 18, an investor education initiative by Kotak Mahindra Mutual Fund. Now, debt mutual funds open up several opportunities for investors, provided one puts in a little bit of effort to understand their concept, their construct, their objective, and of course, their risk levels. Today on the show, we plan to do exactly that. What are the benefits of investing in a debt mutual fund? And why should you consider them? What kind of funds should you consider? And what class of fund suits what type of investor? Very important to get some of these hygiene elements understood and out of the way. To discuss this, I have with me on the show Lakshmi Iyer, President and Chief Investment Officer, Debt and Head of Products at Kotak Mahindra AMC. And we also have Srikanth, Subramanian, CEO, Private Wealth Investment Advisory at Kotak Investment Advisors. Lakshmi, because let's face it, debt mutual funds are perhaps a lot more difficult for the average investor to understand than equity. Equity, large cap, mid cap, small cap, those ideas have still become clear, but debt seems very confusing. First of all, why bother with a debt fund when you have the age-old FDs?
It's a very, very relevant question which keeps nagging most investors' minds and most potential investors' minds also. So if I take the analogy of having a meal on a regular basis, why do you start with breakfast, move on to lunch and have dinner? Why don't you have eggs in the morning, eggs in the afternoon, eggs in the evening? Why don't you have roti dal starting breakfast up until dinner? I gave this analogy just to explain like the way you need a wholesome diet as part of your meal program, and depending on the time of the day, depending on your diet requirements and your body construct, you require varying proteins, varying vitamins, etc. Likewise, your financial portfolio also requires asset classes of varying requirements to suit the relevant scenario in terms of macro or in terms of the overall economic situation given. So therefore, there is a very, very important necessity to have a confluence of every asset class, including fixed income and equities in your portfolio. And within fixed income, again, there is a very strong case to look at a traditional mode of investments and non-traditional mode, which encompasses all debt mutual funds as well.
Let's bring in Srikanth into the conversation as well. Now, Srikanth, when you advise people on how to manage their personal finances, how to look at their wealth, so I guess asset allocation becomes the starting point, right? There's equity on one side, but fixed income is an equally important, if not bigger, asset class for Indians. If I ask a broader question, because most of us are conditioned to open our fixed deposits or our PPF, and then there is the employee provident fund as well, we already have a lot of exposure to fixed income in most cases. Isn't that right?
Yes, while there are plethora of options for an investor on the fixed income side, including conventional options such as deposits, post office schemes, provident fund, as you mentioned. But I think somewhere the overall concept of fixed income has really matured over the last 2 decades. And the kind of investment avenues and options that debt mutual funds offer further diversifies from a point of view of diversification in terms of underlying instruments, diversification in terms of tax efficiency, because most of these debt mutual funds enjoy what we call as capital gains if held for a minimum period of 3 years, as compared to the more traditional form of debt investments, which get classified as interest income. And so it also diversifies the pool of tax bucket for investors. So not only does it diversify various tenors, various quality of underlying, it also gives some efficiency in terms of taxation. So I think from a point of view of broad-basing investor appetite into fixed income, the debt mutual funds is a very important category that one should really be looking at.
Yeah, Srikanth, you raised a very important point, taxation, right? Because let's face it, we're pretty sensitive to this beast. And one of the biggest reasons where you'll find advisors or mutual fund distributors come to you and say, hey, look at debt funds, is because on a 3-year basis, they end up being more tax efficient than traditional items like, let's say, a fixed deposit. But Lakshmi, that's where it's also important to ask the right questions, isn't it? Because many a times these advisors or distributors, they don't tell us what goes into the making of a debt fund. Now, I know that at last count, I think SEBI had identified 16 different debt fund categories. I don't know if that's increased or decreased over the last 1 year. But tell us, how does one even begin?
So the number of categories have broadly remained constant within the fixed income piece. And why it is required is as investors wean out of more traditional form of investments into fixed income mutual funds, it's important to give them a stepping stone towards understanding what goes behind individual portfolios. So I think that's therefore a very critical question that investor needs to ask, because again, let's take the food example, because India relates to food, and I'm a foodie myself. If you try to make upma in rava, the ingredient is rava, but you have to put in salt. But if the same rava were to be used to make sheera, you have to use sugar. So therefore, I think it's very important to understand what is the underlying asset quality of your own fixed income portfolio, which is where the role of advisory is very important, given that there are so many categories of mutual funds, there are so many schemes within that, there are so many permutation combinations. So two-way, first is underlying credit quality, what comprises your fixed income mutual fund, and second is what is the extent of interest rate risk, or what is the duration that your portfolio is running. So these are the two critical questions which one needs to seek answers to, apart from the other, various nitty-gritties which one needs to look at. But I would say these are the two main things which will also determine for what period. So depending on the nature of the answer you get based on these two queries, and that has to be superimposed to match your investor horizon. So that's how the three-way chart is actually made, and you decide your investor allocation.
Yes, absolutely. I think that's a great starting point. And investors must bear in mind that a little bit of homework, we all have to do as well, right? To ensure that we understand the sort of product that we're getting and avoid any unpleasant experiences. So as Lakshmi mentioned, there are two critical concepts. Accrual, which is basically a play on the credit quality, whether the borrower is going to pay back or not. And then there is a duration concept, which is a play on interest rates. Are they going up or are they going down? So Lakshmi, you told us the first step. We'll get this quick, short classroom out of the way, and then we'll simplify it with Srikanth as to who should opt for what. If we look at, the first step, you said first identify how much you need to invest and for how long. So I'm just going to take the prototype of, let's say, someone who wants to have a more tax-efficient way of investing, so which means at least invest for 3 years. So now help us understand that, this interest rate concept, what sort of funds does it impact and how does it play out?
So once you ascertain, as you rightly observed, that you want to be invested, say, for a period of 3 years, which in the current, scenario is reasonably tax efficient, given that long-term capital gains for fixed income mutual fund tenor is 3 years. So once you have decided that, as I said, the next question is that how much of volatility you are willing to fathom. So usually what happens will be is that when the portfolio has a slightly longer duration, the vulnerabilities to movements in interest rates up or down is higher. And vice versa, if you have a very short duration on your portfolio, to give you an example, overnight funds in the mutual fund industry have maturities of just 1 day. So you put in today, the asset matures tomorrow. So it's 1 day maturity. Whereas gilt funds in the mutual fund industry could have maturities of 7 years, 8 years, 9 years, which is pretty similar to some of the investors, owning direct tax-free bonds in terms of duration. So I think that is going to be very important to determine. And that is why I said it has to sink in with your investment appetite and your tenor. So in case of 3 years, it could be a combination of short category funds, long duration funds, medium duration funds. And within that, as I said, the asset quality. So there is no one size fits all where you say that, oh, this checks the box for Srikanth, so it has to check the box for Surabhi. It cannot be that way. The risk appetite which Srikanth has could be visibly different and much higher probably than what Surabhi has. And as far as Lakshmi is concerned, the risk appetite would be, no, I want to be in absolute short maturity fund, even though my horizon is 3 years. Therefore, the varying categories of fixed income mutual funds come very handy to be able to plan that allocation out in line with the objective.
Okay, I think that's a great starting point. So it's become amply clear to us that while investing, we need to bear both things in mind. The credit risk, which is basically whether the fund will get its money back, whether that instrument will remain standard or not. And of course, the interest rate risk, as Lakshmi explained, that today we are entering and the interest rate is X. 10 years later, interest rates could be very, very different, and whether that means profits or losses. These are concepts to keep in mind. Now that the academic concepts are out of the way, we'll take a very quick break. We start applying it to the practicals, and Srikanth will help us do that. How do you select the fund that's right for you? Coming back in just a moment.
Kotak Mutual Fund presents Investmentor in association with Network 18. Kotak Mutual Fund presents Investmentor in association with Network 18.
Welcome back. You are with us on this special conversation, the Investmentor series. And it's a series of conversations that are aimed at helping you understand the mutual fund world better, all the options that are out there. And this week, we're focusing on debt funds or fixed income funds. So, Srikanth, these days, a lot of commentary is veering around how we're at the bottom of the rate cycle. And if we look at the next 2-3 years, I mean, the wisdom of the market tells us that interest rates should be probably higher. So now if an investor wants to invest, then what kind of a fund should they look at?
Each investor may have a unique risk profile and a risk temperament. So while on a broad basing, your point is absolutely right, that today there may be a view that we are very close to the bottoming of the interest rate cycle, and hence at some stage investors may be better off in not locking in very long duration in their portfolio. Because one of the key tenets as far as the duration play of fixed income is concerned, that your profit and loss are inversely proportional to the interest rate movement, which means if you hold your money in a debt fund, if interest rate were to go up, your capital value can come down, and vice versa. If interest rates were to go down, then the capital value that you've invested in the debt fund can go up. Now, this usually sounds very counterintuitive, but it's exactly how fixed income mutual funds work. So from that point of view, if I were to stretch this hypothesis that, yes, we are in a fairly benign interest rate situation, and if the hypothesis gets sort of extended that interest rates can go up, then a common application to that would be that investors at this stage should be more defensive, should be towards the shorter end as far as duration is concerned, just to ensure that when rates go up, they are not caught on the wrong foot, either in terms of having losses in the portfolio or having a feeling of regret that they did not wait for the right opportunity in terms of locking in better yields at a point of time. While that is at a broad level, the general application, given the fact that today there is seemingly a low interest rate regime, but there are again different kind of investors who may have a very laddered approach in their portfolio. They may be okay looking at a 10-year gilt fund, as Lakshmi had given an example. And if an investor feels that what the 10-year gilt today gives me is okay for me, and I'm just going to hold this gilt to maturity, what happens in the interim does not sort of bother, because we are going to hold it to maturity. That investor may still go and invest. But as a general rule, if the belief is that interest rates will go up, then there is a tendency for us to reduce the duration. But having said that, the uniqueness of risk profile should also be superimposed before making a final call.
So Lakshmi, in an environment where interest rates start rising, typically what kind of fixed income funds do well?
Usually in a rising interest rate scenario, as Srikanth rightly observed, the tendency of the money manager, in this case, when we manage strategies, is to try to give lower intensity of movement in rates. So therefore, the typical tendency would be to reduce duration. So that's number one. Number two is active management also starts playing a very critical role because interest rates currently, at least in India, are moving in ranges, and these ranges are gyrating very sharply. For an individual investor, it may or may not be possible to capture those entire moves to the T. So at least the endeavor as a money manager is to try capture those through dynamic fund management. So short to medium duration funds, dynamic funds, and fixed maturity plans. These could be the way. These could be the way out from an investor standpoint.
Now let's come to the other risk. We spoke about interest rates. The other risk, obviously, is the credit risk itself, which is whether the paper that a fund is holding, whether that paper will have a good value or not, whether the money is going to come back or not, or whether the borrower will default. Now, Srikanth, we know that in the last 2 odd years since, there have been enough instances which have sort of shaken up investors, and it brought to the forefront this whole concept of risk and risk management. So what is your advice here?
I think from an interest rate point of view, which we discussed in the previous point, that still can be navigated because there are cycles that come and go, and investors with some bit of volatility can still navigate that point. But I think the big sort of thing to watch out for in a fixed income portfolio is what we call as credit risk, because what one needs to understand is some of the risk reward in debt mutual funds can be very asymmetric, that if without proper understanding, one invests into a debt instrument where the credit quality is substandard, and usually if everything goes right, by investing into not the best credit quality, your upside could be 100, 200, 300 basis points. But in case any of the underlying portfolio were to go belly up, investor can end up losing 10, 20, 30% of capital, depending on what the percentage holding of that particular paper is. So for a very limited upside, a potential downside could be fairly high. And in this regard, it's extremely important for an investor to invest with money managers who have proved it over years in terms of their ability to navigate the right quality of papers, to approach advisors who can help them again navigate through this crisis. But I think it would be also well advised for investors themselves to go beyond the obvious and maybe at least ask 1, 2, 3 relevant questions in terms of the quality of credit in the portfolio. But if you genuinely ask me, between the two risks, the real risk is the credit risk to watch out for. And I think SEBI has also done quite a lot in terms of investor awareness to propel an investor to navigate the credit crisis before choosing a portfolio.
So Lakshmi, on the question of credit, first of all, what should an investor bear in mind? I'm saying worst case scenario. I mean, we need to know what we're getting into. Can capital be entirely wiped out? Then there was this concept of side pocketing, which emerged after the experience of the last 2-3 years. How does the capital come back? How does the fund pay up? I'm just trying to understand, if there is a credit event, then what should the investor be prepared for?
Certainly, if you look at two risks, interest rate risk and credit risk or a credit going bad is a permanent loss of capital. Whereas interest rates going up, obviously the money gets recouped over a period of time. So yes, one needs to be extremely mindful of that, which is why in the mutual fund industry, now you have a category called credit risk oriented funds, where the money manager actually has a mandate of buying below AA assets up to a particular threshold. So investors obviously have to do that extra due diligence along with the advisors when they are contemplating investments into these kind of funds. One good note about the mutual fund vehicle as a method of participation is that the risks are diversified. So it's not that there are all eggs in one basket, because the regulations have threshold, issuer limits, group limits, etc., and sector limits. So therefore, the risk is fairly diversified. Yes, there are risk mitigants, no doubt about it. The redressal mechanism, as you rightly observed, there is side pocketing. So what happens is that out of 100 rupee portfolio, if say 5 rupees is where the credit default has occurred, regulations allow you to carve out another fund or another unit for that, which is called side pocketing, so that it's business as usual for this set of unit holders. And as and when the recovery happens, those set of investors get the money back. So this is definitely a good investor redressal mechanism which the regulators have set in place. But yes, the fact remains that these funds definitely tend to assume a slightly higher degree of credit risk compared to the other category funds.
So again, Srikanth, for someone who wants to now, let's say, end a fixed deposit and move that lump sum money to debt funds, what category of funds would you advise him or her to look at?
It is all about diversifying across a plethora of mutual fund options. So maybe today, because the situation is such, one could begin by being slightly more defensive, by keeping it slightly short-ended on the mutual fund side. But as we progress, along with their money managers and advisors, they should have a slightly more vibrant portfolio, which gives them investment over 2 years, 3 years, 5 years, 10 years, because there are different pockets of money which are required for different periods of time. So after thorough understanding of what monies are required for what period of time, you could have a slightly better laddered approach. Then you throw into the mix that if you want to enhance your return, then you venture into the area of credit, which is where I think a thorough diligence needs to be done across a coterie of investor, advisor, and the money manager fraternities. And on a very conscious basis your risk temperament, you should then take the required exposure, which allows you to get that slightly incremental return. But I think it is best advised that this overall vibrant portfolio should be done over a period of time and not in a lump sum, one-shot manner, given the situation that we are in currently.
Okay, so got that. Basically, I think it's very, very clear that spend some time, understand what you're getting into, talk to your advisor, and then take an informed call. All right, Lakshmi and Srikanth, this has been quite an informative session. Thank you very much for making out time for this particular episode of the Investmentor series. Well, viewers, that's it for this week. But do keep watching because we promise to bring you more enlightening conversations on mutual funds in the weeks ahead.
Kotak Mutual Fund presents Investmentor in association with Network 18.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Focus. Ideate. Innovate. Enable.